Swayam Prabha. Digital India. Educated India.
Namaskar. Now, we will discuss about section 2 of our International Financial Management. Section 2 is devoted to international financial transaction. Before discussing about international financial transaction, we should first briefly outline the experiences from India. India's link with the international trade is as old as the Indian civilization itself. If you analyze the Indian civilization, still from the early Mohenjo-daro civilization to till now, we are more linked to the international environment. The Mohenjo-daro civilization, if you see, if you analyze, there was a trade link with the Egyptian civilization, also with the other part of the world. After 19th century, early 17th, 18th century, prior to the colonial rule, when the Britishers came to India, prior to that, India was known as the hub of manufacturing goods and artifact. India was more developed that time than rest of the world. Indian goods and services, particularly the manufacturing goods, was more demand in the rest with the outside of the country, and that time realizing that India is a manufacturing hub, the colonial other country came to India and tried to develop their international link with India. During the colonial rule, India was converted into a raw material supplier to the rest of the world. The manufacturing hub, manufacturing goods and services was demolished with a knowingly to convert Indian economy into a economy of what is called supplier of raw material to the rest of the world. This process was continuing till early part of the 20th century, and when India got independence, the foreign trade in India was typically colonial and agriculture economy. What does it mean? It means that Indian economy at present, at the time of independence, it was a export of agriculture commodity. It was export center for raw material to the rest of the world. The trade relation during the time of independence was confined to Commonwealth country and the Britain. India did not establish a trade relation with the other European country and with the rest of the world. After the liberalizations, after getting independence, India tried to develop its economy. However, that time sufficient capital was not available. Indian economy was a devastating mode of Second World War, and India was more dependent with the rest of the world than converting itself as a zone of export or a zone of what is called a financial hub. Export during the time of independence consists of raw material, plantation crop, raw material, and also some mineral export. The traditional exports are handicraft was there. Import consists of primarily the petroleum imports, capital goods imports, imports of essential commodities which are not produced by the country, and Indian export imports were more tilted towards import side than export, who had a huge trade deficit. huge trade deficit, and this was a burden on the world Indian economy. This process was continued from 1947 to till mid of 90s, and our trade deficit was ever increasing, and we faced what is called a balance of payment crisis. India was not in a position 1991, India was not in a position to pay for its essential imports, and this has created what is called insolvency for the Indian economy. Rest of the world or the international financial institution, they did not give any loan to India, and India was in a state of insolvency that time. Realizing these problems, after 40 years, we started liberalizing our trade regime, we started liberalizing our economy, and we follow the path of the rest of the world, particularly Latin American country like Mexico, Brazil, and try to integrate with the world economy by establishing a functional trade regime. A functional trade regime primarily means a trade regime which more linked to the world economy. In beginning of the 1991, Government of India introduced a series of reform measures to liberalize the Indian economy. And these measures, the reform measures primarily devoted to the external sector by external sector in the form of liberalizing the current account and capital account, allowing the world capital to come to India and to correct our trade regime, to correct our international balance sheet. In this context, we have to understand whether Indian economy at present is more globalized or it was earlier before. At present, Indian economy is not so globalized as compared to the 17th or 18th century, because we try to impose some kind of restriction till now to protect the domestic economy or domestic environment, because international liberalization means welcoming international instability to the domestic economy, which we do not want at present, because it may create more upheavals in the domestic financial markets, in the domestic environment, which need to be protected for the benefit of the common man. In this context, you have to understand that what actually mean a open economy or a closed economy. Generally, we measure the open economy in the form of trade GDP ratio. The basic indicators of openness, we call it openness. The basic indicators of openness is the trade GDP ratio. The GDP ratio, if it is more than 15%, we generally call the economy is relatively open. And Indian context, after the 1991 liberalization, the trade GDP ratio has been increasing substantially over the year, and this has the trade earlier say 15% to increase to a level of 38-40% at present, because we have introduced a series of liberalization measures which increase our trade GDP ratio. India also a member of WTO, World Trade Organization. India has been a member of GATT, which earlier version of WTO. India has been arguing with the World Trade Organization to allow the developing country to get more freedom in establishing their economy. They need more protection in the form of their domestic economy. They need also a protection in the form of intellectual capital. They need also protection to develop their own domestic environment. If you see, the openness of the Indian economy at present is more than it was earlier before. The financial reform, the financial liberalization in the form of FI investment, in the form of capital account convertibility has brought a huge amount of capital, foreign capital to the domestic economy. Our foreign exchange reserve, which was nearly almost nil during the time of 1991, it has increased to almost 300 billions. They primarily in the form of FI investment, NRI deposit, in the form of FDI investment also. India's openness to cross border trade, particularly the private capital flow, has increased significantly since 1993, because in 1993-94 we liberalized our current account, and also significant liberalization measure taken during the time of for capital account also. The progressive integration of domestic financial market with the international financial market, or domestic economy, domestic financial institution has particularly the banking sector, particularly the developed other financial institution, they allowed to move across the globe. They have been allowed to raise their capital from the abroad. This has allowed them to progressively integrate with the world financial system. Our domestic company are allowed to raise fund in the form of international debt, in the form of international equity from outside of the country. Here the sovereign risk concept is coming over here, because sovereign risk is not good. If the country risk is low, then our cost of capital for the domestic MNC will be quite high. So, Government of India has taken significant liberalization measure to protect the fiscal deficit, to reduce the fiscal deficit over the year, because the fiscal deficit or the current account deficit primarily linked to the sovereign risks or sovereign rating. If you see the political risks, the transaction cost, high cost of capital, high taxation, the capital control measures, these are the imperfection in the environment, in our international financial movement, and this has been reduced over the year Indian context. However, till now our political risk is quite high compared to other developed country. Political instability is still there in Indian context. Our transaction cost in the form of movements of capital also quite high. Our taxation, though it has been reduced over the year, till it comparably high if you compare to our domestic neighbors. The capital control, still we are imposing some kind of capital control to so that to protect the domestic economy from the international financial instability. However, prior to 1991, our economy, our international environment is quite developed, and it has created a environment where domestic MNC, domestic FDI, domestic companies are borrowing for capital from the abroad. Our international environment has allowed the foreign counterpart, particularly the MNC, to come to India and invest. This has increased our international capital inflow, and with this example will let us try to move to the other part of the world trade system, because if the international financial transaction not only depends upon the domestic environment, but also the world economy as a whole. In world economy issue, prior to the First World War, the growth world trade was quite smooth, because there was no such kind of problem in convertibility, because the gold was the primary currency all over the world. There was no such kind of problem in exchange of currency. However, with the collapse of the gold standard, the world monetary system quite unstable, and this has further created problem with the First World War and Second World War. After the First and Second World War, many countries got their independence, and they started in the form of creating a tariff barrier particularly to protect the domestic economy. And this has affected the world smooth flow of world trade, and realizing this barrier, world level economists, world level economists and a financial analyst, they analyze that it is this tariff barrier has created some kind of difficulties in the movement of trade and services, and they establish what is called the world level financial institution, particularly the GATT and IMF for the smooth flow of world trade. Member countries of IMF and GATT, they over the year negotiated for many such activity, so that they can country can reduce their tariff barrier for the smooth flow of world trade. In this context, you have to understand that we have established the GATT. The GATT already we discussed in the session 1. GATT is General Agreement of Trade and Tariff. The GATT is essential. GATT was in world level institution which help in reducing the tariff, the custom duty, the anti-dumping duty, the non-tariff barrier for the smooth flow of goods and services. Over the last 50 years, GATT has negotiated with the different member country for the reducing the tariff barrier. One such negotiation round we generally call the Uruguay round, where the biggest negotiation take place, and in this negotiation the member country agreed to reform the many such area of world trade, particularly the area of what is called services export, agriculture commodity export, textile exports, intellectual properties, and also intellectual capital flow. And in this context, the Uruguay round is known as the rapid liberalization round, and the Uruguay round we established convert the GATT into WTO, World Trade Organization. World Trade Organization has been campaigning for the tariff free world economy, where all country will get the benefit of trade liberalization. With this discussion, let us move that to what is called international balance sheet, because movements of goods and services and foreign capital lead to a different kind of balance of payment, and this balance of payment is essential to understand, because the balance of payment take into account international foreign currency. We call this balance of payment international balance of payment, where because international currency will be a part of the international transaction of goods and services will be the part of the international balance sheet. If you see the international balance sheet, has two aspects. First aspect is called current account, and second is called capital account. In the current account, we have export import, that is called merchandise account. In merchandise account, we have export import. Country export and import different goods and services, that will be the part of the merchandise account. Second within the current account, we have invisible account. Invisible means there is no link to any export import in export import goods. It is primarily services export import. We call it international travels, we call it transportation, we call it insurance, governments account flow, and many miscellaneous will be there, like interest payment, insurance payment. It is a part of the invisible account. And in next part is called transfer account, because government to government transfer of funds will be the part of that. Here also private transfer of funds also there, corporate bodies also transfer their funds from one corporate to another corporate among the countries. So, that is also part of the transfer account. And also we have an income is called investment income, compensation to employee, because many countries have their own embassies foreigners are also working there. So, their income will be a part of the income, investment income, compensation to employee, these are the income side. So, current account we have called merchandise account, invisible account, transfer account and income account. The current account, primarily the merchandise account is largest in nature. If you see in Indian context, the current account we have export import, the import is quite larger than the export, and which is called the deficit, we call trade deficit. When export minus import is the negative in Indian context, because our import is more than our export, and for that reason we have a negative merchandise account or trade account, and this negative has been increasing over the year, and the our exports are not in a position to pay for our import. For that reason we have a negative trade deficit. The negative trade deficit is offset or reduces by a positive flow of invisible account. Indian context we have a significant invisible inflow. The invisible inflow in the form of NRI deposit, in the form of our peoples are working abroad, in the form of our FI investment. These are the part of the invisible account, and this invisible account net is positive for India, and because of that reason our trade deficit is reduces. However, trade deficit reduces. However, at present when the current account in Indian context, we have merchandise account, export imports. Our imports are less than our imports are more than our export. For that reason, we have current account, particularly merchandise account deficit. And trade deficit is this trade deficit try to we have been correcting the trade deficit through invisible inflow. The invisible inflow in Indian context is primarily the NRI deposit, FI investment, invisible short term capital flow. The invisible in Indian context is increasing after the liberalization measure, and for that reason we have reduced our current account deficit. However, because of the world recession, we are invisible side is reducing, and this has created a more current account deficit. So, current account deficit is primarily in Indian context because our imports are quite larger than our export. Our exports are not in a position to pay for our imports, and this invisible this current account deficit need to be corrected through a trade liberalization or a current account liberalization by allowing more inflow of invisible. If you current account is important because the current account as a indicators of our financial sector stability. If high current account deficit lead to financial instability, and this will create more problem for the domestic economy, because our domestic currency will depreciate and further, and the depreciation lead to more increase in our import in value term, and our export may also suffer. If you come to the current capital account side, the capital account have foreign investment, that is maybe direct and portfolio investment. The foreign direct investment is called direct project investment, or the technology or the MNC coming to India, establishing the company in India, there is direct investment, and portfolio investment primarily in investing stock market. The portfolio investment, the foreign or may invest in bond market in the form of the investment. Our many MNC also invest, foreign investor also invest in our bond market, our treasury bill, government debt market. This is also part of the foreign investment. Also, our domestic MNC, domestic company borrow from abroad in the form of loan. They borrow from the international financial market, they borrow from international financial institution, that is called commercial borrowing, long and short term borrowing. Our external assistant many such countries are there, world trade bodies are there, they also give assistance to our economy in the form that assistance may link to some kind of project finance, some kind of goods and services. It may be direct financial assistance, it may be in the form of assistance in the form of goods and services. Our banks are there, they have branches in abroad. So, their commercial banks assets and liability may also be in the form of foreign currency, and non-resident deposits which are coming through the commercial bank is a part of the commercial bank's asset, liability and liability side, and all these are called capital account. Capital account in India is significantly levelized in the form of direct foreign direct investment. Many of our industry, particularly different sector of the economy has been open to foreign investment for both for direct investment and portfolio investment. This has created environment for India. This has created environment where foreign MNCs are coming and investing in India, and our foreign currency reserve is increasing. For our domestic company has got the freedom to raise money from abroad in the form of loans and commercial borrowing, because there is no requirement on the part of the domestic company to borrow from abroad. The only caps are there for different sector. External assistance is not significant in Indian context. However, NRI deposit in the form of commercial bank is quite high. So, this has give boost to our current capital account. Capital account liberalization is essential for more flow of foreign capital to India. After knowing this capital account and current account, we should also discuss the linkages between capital account and current account. If you see, the current account is generally 1 year in nature. Our export import generally get their payment within 3 months, 180 days, 3 months to 6 months. The invisible is a continuous flow in nature. Transfer payment, official transfer payment also in continuous in nature. Current account, the merchandise account and invisible account is quite significant. If you go to the capital account, the capital account only the foreign investment and commercial borrowing, loans and commercial borrowing is quite significant. Commercial external assistance is not significant in Indian context. So, in capital account we have foreign investment that is direct in portfolio is quite significant, loans and commercial borrowings are quite significant. If you current account, if you go the merchandise account and invisible account quite significant, and the current account, as I mentioned, that current account we have deficit because our exports are not in a position to pay for our imports. However, by invisible inflow has reduced the current account deficit significantly. In our export side, we have significant part of portfolio investment, which are portfolio investment rather than direct investment. So, direct investment has been increasing over the year, but the primary contribution of foreign capital inflow is the portfolio investment. Portfolio investment create instability in capital account, because this portfolio investment linked to our stock market, and these are hot money movement, and this hot money movement may go out from the country any moment. So, for stability of the capital account, we need direct foreign inflow, direct FDI investment and loans and commercial borrowing rather than portfolio investment. However, portfolio investment also have contributed significantly in the growth of our foreign exchange reserve, but for stability of our foreign exchange reserve, we need more direct foreign FDI and export. If you see the stability of the international balance sheet of our country, the stability required, we have to our exports should pay for our import. We should have a net invisible, and at the same time in the capital account we should have more foreign direct investment and foreign direct investment, and also we should have more loans and commercial borrowing. At the realizing this, we have to give more importance to the levelization of the capital account, current account, and more levelization to the capital account. At present, Indian economy is completely levelized in the form of current account. However, capital account we have significant debilitation. And if you see the international balance sheet, generally some country have a third account is called reserve account, which is nothing but the transaction of the central bank. The monetary authority, in case of India it is RBI, in monetary authority some other countries also there. They among them the transaction take place, it is through the reserve account. Our reserve account, international assets and liability for which transaction conducted by the monetary authority, that is RBI, is called the reserve account. After knowing this current account, capital account and the reserve account, we should also understand what is called trade deficit. Trade deficit, as I mentioned here, trade deficit is export minus import, and also you should understand current account deficit. Current account deficit is export minus import plus net invisible net. Net means invisible receivable minus invisible payables. So the trade deficit in Indian context is negative, because our export is less than our import, and current account deficit also in Indian context is negative in nature, because the significant part of the negative part of the current account is a trade deficit. Some extent the net invisible inflow has corrected the current account deficit or reduced the current account deficit. However, over the year we have current account deficit. So, current account deficit need to be corrected, because our sovereign rating, country rating depends upon the current account deficit. If current account deficit increasing, then we will get a bad rating from the international rating agency. At the same time, current account deficit is increasing, our rupee will depreciate, and this will affect our this will increase our value term of imports, or our essential imports would be affected, because significant part of our essential import are the petroleum import. With the depreciation of the rupee, with the more current account deficit, the value of the current import will also increases. Many of our import also have capital import, or the imports in the form of essential raw material, capital goods inflow, capital good import. This also be affected because with the depreciation of rupee. So, we need to correct the trade deficit, and also we need to correct the current account deficit. So, after analyzing the international balance of payment, we should also understand a current account position in case of India. The current account position in case of India, I have given a table to you. This table in from RBI handbooks on trade and RBI handbooks on Indian economy, data on Indian economy. This I have given here that current account last 10 years. If you see the current account, first is the merchandise account, what is called export and import. The trade export minus import, if you will get the trade balance. The trade balance is, if you see the trade balance, invisible net trade balance is negative, and it has been increasing over the year. You see the US dollar in million, something of 11,000 million, it has increased to 189,759 million. This is because over the year the trade deficit is increasing in Indian context. The trade deficit increasing primarily, no doubt our export is increasing, or at the same time our import also increasing, import bills also increasing. If you see last 10 years that export has increased significantly, at the same time import is also increased significantly. No way not a single where we have a export is more than our import. Similarly, our invisible, though it has been increasing over the year, but it is not in a position to control the trade current account deficit. Few years, particularly the 2001 to till 2003-4, we have current account deficit, current account surplus. This current account surplus primarily because of the invisible inflow. invisible import, because in 2001-2 to 2003-4 our trade balance, that is export minus import, is more, is negative, but the trade balance, that is export minus import, is negative. However, invisible flow has corrected the trade current account deficit, and we enjoy for 2001-2 to 2003-4 a surplus current account. However, after that current account deficit has been increasing over the year, because the inflow of invisible account in net position, though increasing, is not in a position to reduce the current account deficit, not in a position to reduce the current account deficit over the year. Current account deficit has been increasing over the year. If you go see the export import, if you go further analysis of export import, then our export though increasing, our import also increasing at the same time. The import is primarily inelastic in nature in Indian context, because significant part of the imports are oil import, crude oil import, which is inelastic in nature, in the sense that despite that we have a current account deficit, we are forced to import, because these are essential import, but our export is primarily elastic in nature some extent, because some manufacturing goods are there in the basket of export, and export also last for 10 years. Our export is a soft export in the form of what is called the softwares, computer softwares has been increasing, and it has given a good strength to our export basket. If you go further, that current account deficit, the invisible net, if you see the invisible side, the invisible travel, transportation, insurance, government in miscellaneous, these are invisible account. This travel is for the tourism side, transportation also, insurance, we are paying insurance in the form of a port, our freight, our export imports are going, our export imports are there, we pay insurance payment for that, is a part of the invisible insurance payment. However, travel tourism is India is a destination of travel and tourism. For that reason, we are getting significant amount of foreign exchange, that is a part of the invisible. If you see the other part is the commercial bank non-resident deposit. Non-resident deposit is a significant part of our inflow to foreign exchange inflow to the country. Non-resident is our Gulf country, many of our citizens are working in abroad. They are sending the money in the form of the deposits, the foreign currency deposit, that is a part of our commercial bank, that is a part through our commercial bank, that is a part of our capital inflow. This has also helped in reducing the current account. If you see the foreign investment, the portfolio investment has increased significantly over the year. Foreign direct investment has not been contributed significantly to the capital inflow, but the portfolio investment is, I already told you, unstable in nature, and it creates high volatility in our stock market. However, Government of India has been liberalizing the capital account through the liberalization measure in the form of trade liberalization, in the form of opening of the economy to the foreign direct investment. So, that only can breach the current account and capital account deficit. If you see over the year, the portfolio investment has contributed significantly to the capital inflow. If you see our composition of our capital account, it is the portfolio investment which contributed significantly. However, on the other hand, our domestic companies have raised significant capital from the abroad in the form of diluting their equity or by directly borrowing from the international capital market. This also has brought significant amount of foreign currency to the country. In this context, if you see in this context, the merchandise side of export import, you have to go further, because to to understand the export import basket. The export import basket contains the true picture of our own money, because if you see the own money, own foreign exchange earning, the earning of the country is nothing but the export side or the some part of the invisible side. But when export import are not in a position to balance the other word our export not in a pay for our import, then we will face a trade deficit which need to be corrected through the invisible inflow. But invisible inflow also linked to the what is called a business cycles, because in a recessionary environment invisible inflow may not be there significantly, and this because at present also if you see at present particularly that after the subprime crisis world economy is recession phase, and this has reduced our invisible import, invisible flow to the country, invisible flow in the form of travel tourism, in the form of government inflow. This has reduced over the year, and this has increased our trade deficit, this has increased our current account deficit. At present particularly 2007-8 onwards, if you see the data said 2007-8 onwards, the current account deficit has increased significantly, because the invisible part though increasing, it is not increased as much as it was earlier. This has because the trade invisible part also linked to business cycle, and the world economy in a phase of recession cannot generate significant amount invisible flow, and for that reason you have to labelize our trade account in such a way that our exports should pay for our import. It generally mentioned that if you see economic literature that when economy is a balanced economy, when economy is a balanced in nature, the economy will be balanced when our export pay for our import. This only give a true picture to the international payment account. The international balance of payment will be stable in nature if our export pay for import. But however, since India as a country where the significant part of our imports are oil import, which are inelastic in nature, which are essential in nature, we cannot reduce it. Only we have to increase our export, and export, if you see our export over the year has increased. However, this has not in a position to pay for our imports, and in this context we have to understand that nature of our export and the composition of our export. That we have to change our composition of our export to go more towards what is called a value added export rather than a destination of export for raw material or the non traditional goods. So, before coming to the end of this session, let me tell you one thing here, that trade deficit definitely will have, because we are our country not in a position to reduce the import side, which is inelastic petroleum import, but we have to increase our export basket to maintain a trade deficit which should not affect or should not give a high amount of current account deficit. On the other hand, we should give more importance to our invisible inflow, which also have larger bearing on current account deficit. The current account deficit can be reduced by increasing our export and increasing our invisible inflow. Before coming to end, let me tell you that if you want to understand the direction of our export, direction of our import, composition of our export import, the composition of international balance sheet, you have to go to the RBI website and see the handbook of statistics on Indian economy. RBI publish every year this statistics, and this will help you in understanding our export basket or import basket or various component of import invisible side, and also the composition of our capital account, that is whether our capital account is more foreign direct for FDI side or more for portfolio investment. Okay, this reference is Handbook of Statistics on Indian Economy published by RBI. The model question is here. Before coming to end, let me tell you one thing here. You have to discuss our model question. The outline here, outline the step to improve the current account surplus in Indian context. The first model question. Second model question is here. What are the primary reasons of high current account deficit in India? First question, if you, I will give you some brief bullet point for this first question. The outline the step to improve current account surplus in Indian context. To maintain the current account surplus, this is we have to see what are the main component of the current account. As I mentioned in the session discussion part, the current account have export, import and invisible side. The export import as export imports are the merchandise account or trade account. The export import in Indian context, the exports are less than our import. So, we have a current trade deficit, and also in invisible side we have tourism inflow, we have inflow of insurance, freight, inflow of interest payment, other things are there in the invisible side. To improve our current account surplus, we have to control our import side, non-essential import you have to reduce, we have to increase our export side by going for more value added export, more manufacturing export. So, to improve the improve the export basket. At the same time, we have to go for more export oriented unit, establish the export oriented unit, so that give more incentive to the company which are exporting goods and services. The export sector finance should be provided by the government of India. Those companies, those sector of the economy which are exporting more, they should be given more freedom in by reducing the export duty. They should give more liberalized or low interest finance. They should not be tax, should not be less tax, should be less tax, and at the same time also there should be more freedom in the form of allowing them having more access to port, more access to transportation sector, so that they can export more goods and services. At the same time, government should transfer the technology to export oriented unit, so that more export can be possible in Indian context. At the same time, we also see how we can improve the direction of our export to other country. We have not tapped the market of South Africa side, African countries side. We have not tapped the market of the many other Asian countries, so that we can if you tap this market, we can export more also. This surplus can only be possible, current account surplus can only be possible if we improve our export side. And at the import side, non-essential import, particularly the gold import, which are non value added import, we should reduce the gold import also, because significant part of our import basket also have gold import, which are consumed in domestic market. And recently, particularly the 2011-12, our gold import is more, and which has contributed significantly in current account deficit. So, non-essential import should be reduced, and essential import try to optimize or try to use in a productive way. And second question is what are the primary reason of high current account deficit in India? I told you, we mentioned in our discussion part also, the high current account deficit in Indian context is the current account trade deficit. Trade deficit primarily because of the because of our essential oil import, and our imports are so much that our export are not in a position to pay for our import. Because of this reason, we have a high current account deficit. And in the at the same time, if you see, if you segregate the import basket from essential oil import, technology import, raw material import, and some essential commodity import, the non-essential import should also be reduced. Now, I mentioned in the first question while discussing the non-essential import is the particularly the gold import. The gold import should be reduced by imposing more tax on the non-essential gold import, and only this we can reduce the current account deficit. Other reason of current account deficit is the depreciation of rupee. Depreciation, because when current account deficit is more, the rupee depreciated more. When rupee depreciate, our value of our import in the form of US dollar will be more, and this, and also the import of essential goods, technology, manufacturing goods, which help in our export oriented export, which help in our export also costly, and this further affect our export. So, in this context, we have to understand that current account deficit is a what is called a problem itself, and once you start, it create more current account deficit, because current account deficit lead to depreciation of rupee, lead to increase of what is called decrease of sovereign rating or country rating, and lead to create instability in the economy. And current account deficit once started, very difficult to reduce it, and current account deficit need to be controlled by controlling the non-essential import, increasing the export basket, and also increasing our invisible inflow. Current account deficit is a problem itself. In this context, we have to look the current account deficit, what that the contributory part of the current account deficit. The contributory part of the current account deficit, sometime it is non-essential import, or maybe depreciation of rupee, depreciation of the domestic currency, and this depreciation of domestic currency can be controlled by liberalizing the current account and capital account itself, by allowing the capital inflow to the country, by allowing our export to go across the world, by controlling the non-essential import side. And in coming to end, let me tell you one more thing here, that the international environment, particularly the domestic environment and international environment, they go together. We have a domestic stability, then only you can provide a international stability. Domestic stability is essential for the stability of the international balance of payment, because our domestic stability provides a environment for inflow of foreign currency to the domestic market. If foreign currency to the domestic market come, then only possibilities are there, our current account deficit will be corrected, and our balance of payment will be in a stable format. And the stability of the balance of payment not only requires the stability of the domestic economy also. Thank you.